It's a video question from Kevin. Let's roll it.
He wants a video question. I got a video question for you. Fortis, what do you think? Other than my hair is horrible. What do you think of Fortis stock? Love to know. Bye.
I don't know if he's mocking my hair there, or it's been known to.
I think his hair looks great. He's got hair. That's better than a lot of people.
Fortis, the utility, people like it. It's gone ahead with its own giant U.S. acquisition.
Yeah. So look, the utilities are not my favorite space. If we think the economy is getting better, it's not the most economically sensitive group. However, if you think rates are going higher slowly over time, then you need to be able to find, I think, a dividend stream that will grow a little every year. And so while this isn't going to be a rocket ship, Fortis has had, probably the best record in Canada for dividend growth over time. Mm-hmm. And they grow at 5, 6, 7% a year, and it's got a 3.5% yield. It's a good mix between regulated utilities and non-regulated, so they've been able to grow. And they're likely to continue to. So if you think 3.5% sounds pretty good relative to a 10-year bond at, 2.17%, and it's going to grow 6, 7% a year, I think that's pretty attractive. We own some Fortis, although utilities for us are a underweight sector within most of the portfolios, just because we prefer some of the more economically sensitive groups. But Fortis is a great company.
Okay, and keep sending those video questions. They get you to the front of the line with your favorite market call guests. We have Kate calling from Winnipeg. Go ahead, Kate, please.
Good morning.
Hi there.
I would like your opinion on semiconductor, ON in the States.
Yeah. So again, this is right in the center of the semiconductor theme. They have an international group of clients. Lots of international revenues, companies growing quite nicely. The revenues have grown over the last 3 years from about $700 million to about $1.3 billion. So they've got nice revenue growth, and they have sales into medical, computing, industrial, networking, aerospace. So look at these semiconductor companies have tentacles into almost all industries, and onsemi's done a very, very good job. So we don't own it currently. Mm-hmm. We have some other names, but I have no problem with onsemi as a company to own.
And just remind, what was that semiconductor ETF?
XSD is the unweighted index of semiconductor manufacturers. Unweighted. So if you buy SOXX, which is the large one that lots of people buy, you're buying a very, very heavy weighting in Intel. Okay. And not that Intel isn't a good company,
but it's unbalanced. That
XSD is sort of 1 to 3% weightings across a broad basket of semiconductor manufacturers.
There you have it.
And I think it's a great way to play it.
And quite a run there over the past year, up almost 40%. Yeah. Okay, Ed in Apsley, Ontario. Go ahead, Ed.
Hi, David. Thanks for taking my call. Calling about Sierra Wireless. It's had quite a run this year, and lately it's been bouncing around a lot. I'd love to hear your opinion.
Yeah.
Thank you.
So, it's difficult as Canadian investors, and there are lots of managers who need to own Canadian names. And Sierra Wireless has had some great runs in the past, and they've had some real difficulties in the past. Their products sort of come into and go out of favor. If you have a choice, I'm not sure that this is the one I would pick within the group. I would prefer to own one of the larger names, and I'd probably focus in the semiconductor space. Look, it's in the right group for sure. The stock's acting well, but just remember that you're investing alongside some people who are forced to be in Canadian technology companies, and so it's not my number one choice.
And when you say forced, just their mandate sets.
There's a lot of mandates which are Canadian equity mandates, and if tech is running, they got to own some Canadian tech names, like buying Canadian biotech companies. Not to say that there can't be some good ones, but there's a broader pond to fish in, and I think that some of the large multinational U.S. companies might be a little more attractive.
We've got Jerry calling from Vancouver. Go ahead, Jerry.
Gentlemen, David, Tech Resources, buy, sell, or hold. It's below $20 right now. And Andy, street consensus, please. Thank you.
Do my best on that. Okay. Thanks very much, Jerry.
I'll be pretty brief. Last year, 2016, was a great year for a bounce in commodity prices. I believe we're in a long-term secular bear market for commodities, which means cyclical advances and declines, but you don't really make much progress. If you look at the broad basket of commodities, and you look at DJP, which is an ETF broad-based, GCC, technically they're very weak. Considering the fact that the US dollar pulled back versus all world currencies over the last 4 months, that should be a fruitful time for commodity prices, and they fell through the period.
That's interesting, yeah.
So I'm very cautious on energy. I'm very cautious on metals. You know, in truth, in our macro strategy, we're short metals, we're short gold, we're short energy. Tech is a basket of these things. I would avoid this group for now.
Why are you cautious on commodities?
Commodities tend to do well when you're in an emerging market cycle. If you look at the markets that are doing well right now, they are developed consumer-led markets that do well in a low inflation world. So Japan, the US, India, Germany, these are all countries that tend to do well when inflation is generally low. And China is not really fueling the growth in the global economy. There's no shortage of commodities in world markets currently, and that's what you need to have a run in prices.
And tech, analysts still like it. 17 buys, 4 holds, and 1 sell. We are going to take a break, and we're going to be back with David Burrows. He's President and Chief Investment Strategist at Barometer Capital Management, and he's answering your questions on North American large caps at 1-855-326-6266.